Welcome to the Deep Dive, where we try to cut through the noise and get straight to the crucial insights from the information you've shared with us. Today, we're taking a deep dive into a company that's been making some pretty big waves and sparking even bigger debates in the tech world, Guerrilla Technology Group, Inc., trading under GRRR. Our mission today is really to unpack the full story behind Guerrilla Technology. Now, they position themselves as this high-growth AI player, but, well, they come with some significant controversies swirling around them. We're going to dissect their financial performance, their, let's say, bold operational strategy of securing these massive global deals. And we'll analyze all the key points, the good, the bad, the promising positives, and the substantial negatives that really any potential investor needs to understand. And of course, we'll flag up the main milestones to keep an eye on for the future. So let's get right into it. Guerrilla Technology's recent Q1 2025 financials, they paint a truly fascinating picture, almost contradictory, really. On one hand, the headlines, they sound undeniably impressive, a striking 109% year-over-year revenue increase, hitting $18.3 million. And when you look at their preferred non-GAAP metrics, they report significant growth, profitability even, with adjusted EBITDA at $5.16 million and adjusted EPS positive $0.23. That sounds like a company on a rocket ship, doesn't it?
It certainly does on the surface. But this is where the quality of those earnings really comes into play for you, the potential investor. While those adjusted numbers paint that picture of, rapid scaling and profitability, the official GAAP figures, generally accepted accounting principles, they tell a very different story. For the exact same period, Guerrilla actually reported a GAAP operating loss of $4.17 million and a GAAP net loss of $4.56 million.
Wow, that's a massive gap. What exactly is driving such a, divergence between their adjusted numbers and the standard GAAP figures?
Right. The significant difference is primarily driven by two really large items. First, there's a staggering $4.4 million currency exchange loss, and that's directly linked to the sharp devaluation of the Egyptian pound. Remember, their largest contract is based right there in Egypt. Second, there's a $1.8 million fair value remeasurement of financial instruments. Now, think of this as sort of changes in the theoretical value of certain financial assets or liabilities they hold. It adds to the reported loss on paper, but it's not necessarily tied to their day-to-day operational performance, you see.
I see.
So when Guerrilla says they're profitable, you really need to ask, okay, but under which accounting rules? Because GAAP, the standard one, reveals real losses. And that raises serious questions about the actual quality and the sustainability of their earnings.
And it gets even more interesting, doesn't it? Beyond just the top-line revenue soaring, if you dig deeper into their profitability, that gross margin compressed dramatically. It plummeted from 85.1% in Q1 2024 down to just 35.1% in Q1 2025. That's a huge shift in just 1 year. What does that tell you about their business?
Well, that dramatic margin compression, it suggests a pretty fundamental shift in their core business model. See, Guerrilla markets itself as an AI-based IoT and SaaS company. IoT, that's Industrial Internet of Things, basically. Smart tech connecting machines in industry. And a typical SaaS company, software as a service, well, they should have very high scalable software margins, often, 70, 80% plus.
Right.
But Guerrilla's 35.1% gross margin, it points to a role more like a prime contractor or maybe a systems integrator. This involves buying and integrating a lot of third-party hardware services, and those inherently carry much lower margins. This has really profound implications for how the company should be valued by investors. You just can't value a business with 35% gross margins like you would a pure software company. It's different.
Okay, let's pivot a bit. Let's talk about their balance sheet. The company's highlighted what they call a strong cash position, $33.8 million. That includes cash and restricted deposits. And they've apparently been disciplined about reducing total debt, bringing it down to $17 million after the quarter closed. Sounds pretty solid, right?
It does sound solid, but again, it's important to understand the nuance here. Their deleveraging, their debt reduction, it's been cash neutral.
Cash neutral, what does that mean exactly?
It means they weren't necessarily paying down debt with new cash generated from their core business, their operations. Instead, as they paid off specific project financing, an equal amount of restricted cash was simply, released. It's sort of like paying off your car loan by moving money from a dedicated savings account, not necessarily from your monthly paycheck.
Got it.
So while the debt number went down, it didn't necessarily come from operational free cash flow. That's a key distinction. Also, there's a substantial $44.3 million in unbilled receivables. Now, this represents revenue they've recognized, but they haven't actually invoiced yet. This ties up significant capital that needs to be efficiently converted to actual cash for future liquidity. That's definitely something for any investor to watch closely when looking at cash flow.
Right. And finally, on the financials, their capital structure, it presents this really interesting push and pull dynamic. On one hand, they're actively buying back shares, completed $5.4 million out of a $10 million program. That usually signals confidence. But on the other hand, they're facing significant dilution from outstanding warrants being exercised. That increased shares outstanding to over 20 million in Q1 2025. What does this mean for existing shareholders?
Yeah, it creates a dual impact, really.
Yeah.
Share buybacks are generally seen as positive, right? They signal confidence, potentially boost per share value. But the ongoing exercise of warrants, while it provides the company with cash, it simultaneously dilutes existing shareholders' ownership. Their slice of the pie gets smaller. So the net effect on earnings per share, and well, it's going to depend entirely on the balance of these two opposing forces. It's a complex dance, trying to return value while also bringing in capital, sometimes at the expense of those existing shareholders.
Okay, let's move beyond the numbers for a bit and look at what's supposedly driving GRRR's growth. They position themselves as a leader in AI-based industrial Internet of Things solutions. They talk about over 22 years of experience, 29 granted patents, a suite of solutions like their intelligent video analytics, IVR, sounds like a proper tech powerhouse. But there's a counter-narrative floating around, isn't there?
Oh, absolutely. This whole proprietary tech narrative is a major battleground. You've got short sellers making some pretty serious allegations claiming the company's tech abilities are practically non-existent and that they just rebrand off-the-shelf hardware. Strong stuff. The reality, it likely lies somewhere in the middle. GRRR probably isn't just a pure software vendor. They seem more like a sophisticated solutions provider, a systems integrator. They combine their own analytics, sure, but with best-in-class hardware and software from big partners like HPE, Cisco, Intel. Their competitive advantage might not be inventing every single piece of tech from scratch, but rather their ability to design, win, and then crucially execute these incredibly complex integrated solutions for these massive projects.
Okay, building on that, their business model really does feel like a big game hunt, as you put it. They're focusing on a small number of huge multi-year contracts, often with governments, their biggest. That $270 million three-year deal with the government of Egypt for a smart government security convergence solution. Then there's a $20.8 million contract with Taiwanese law enforcement for a 5G network investigation solution. That's significant too. And looking ahead, they have this monumental memorandum of understanding and MOU for $1.8 billion over 15 years to lead Thailand's energy digitization. And another MOU, this one for 20 years, to transform Santa Marta, Colombia into an AI-powered smart city. I mean, this is incredibly ambitious stuff.
It is, and this big game strategy, it absolutely validates their ability to operate at a national scale.
Sure.
That's impressive, no doubt. But, and it's big but, it also leads to extreme customer concentration.
Right.
Historically, like as much as 94% of their revenue came from just two customers,
Yep.
Egypt and the Taiwanese CIP.
94%, wow.
Yeah, that makes their revenue streams incredibly lumpy, very high risk, and really vulnerable to delays or political turmoil affecting just one single project. Take that $1.8 billion Thailand MAU, for instance. It's non-binding right now. Its conversion to a definitive contract is a major potential catalyst, sure, but it's also a significant risk hanging over the company. An investor just cannot value GRRR like a predictable, diversified SaaS company. It has to be assessed as what it is, a high-risk, project-based business. Imagine if that MOU falls through. It's not just a minor step back. It's a fundamental blow to their whole long-term growth story.
That's a really key point. Now, interestingly, maybe to counter some of the scrutiny they've faced, GRRR has cultivated this ecosystem of really high-profile partnerships. They've got an OEM agreement with Hewlett-Packard Enterprise, HPE, which lets them leverage HPE's global infrastructure. That's huge. They're the core technology partner for the One Amazon initiative, focused on sustainability in the Amazon rainforest. And they've partnered with Toyota Material Handling Solutions in Thailand to co-develop next-gen smart warehousing. So is partnering with giants like HPE and Toyota just a smart business move, or is it maybe also a calculated PR play?
Well, if we connect this to the bigger picture, these alliances probably serve a dual purpose. Operationally, yes, they absolutely provide a scalable backbone for global project delivery. You need that for projects of this size and complexity. But perhaps even more importantly, they function as a powerful credibility by association campaign. This directly counters that damaging narrative coming from the short sellers. The willingness of companies like HPE, Amazon, Toyota to publicly align themselves with GRRR. That provides a potent piece of counter-evidence to those fraud allegations.
Yeah.
It's much harder for a short seller to credibly claim your technology is non-existent when Intel and HPE are publicly partnering with you right now.
That makes sense. Okay, this leads us nicely into the competitive landscape, which for Gorilla seems surprisingly confusing. Different financial sources seem to place them in vastly different peer groups. Sometimes it's small-cap software companies, other times it's mega-cap platforms like Microsoft or Palantir. So what does this tell us? How should we think about their competition and valuation?
Yeah, that lack of a consistent peer group really highlights that Gorilla operates in a, well, truly unique niche. It's at the convergence of AI software, IoT hardware, cybersecurity, and large-scale systems integration. It's a mix. They may have effectively carved out a category of one as the go-to prime contractor for these highly specialized end-to-end smart country AI infrastructure projects. In that light, maybe their true competitors aren't really software companies at all, but rather those large global systems integrators. Think Accenture, Capgemini, the kind of firms who would bid on these unique, massive government tenders.
And this ambiguity, it fuels what some call the SaaS multiple dilemma around Gorilla's valuation. The bull case, often pushed by their investor relations firm, argues that their current price-to-sales ratio is a compelling bargain compared to the high multiples you see in the SaaS industry. But based on what you said about margins, is that comparison even valid?
That's arguably the most important question for investors right now. Is that comparison valid? The entire undervalued thesis rests on the assumption that Gorilla's business is comparable to a typical SaaS company.
Right.
But as we discussed, their gross margins, 35.1%. They're far lower than the 70-80% plus you see in high-margin SaaS. That's a huge difference. Moreover, their revenue is highly concentrated, it's project-based, it's not diversified, predictable, or recurring like a typical SaaS model. So applying a high SaaS multiple, well, it appears to be a fundamentally flawed premise. The market might actually be correctly valuing them as a project-based systems integrator, which typically trades at lower multiples. You just can't treat a project-based business with lower margins the same way you treat a pure software subscription business. It doesn't equate.
Okay, adding another layer of complexity is Gorilla's ongoing, very public battle with several short-selling research firms. These firms have levied some pretty audacious claims, everything from fabricating its business entirely to having non-existent tech and questionable contracts. Now, short sellers obviously have an agenda. They profit if the stock goes down. So how much weight should we give these accusations, and how is Gorilla fighting back?
That's a crucial point to remember. Short sellers do profit when a stock declines, so considering their motivations is always important. However, these are undeniably serious allegations. In response, Gorilla has launched what looks like an unusually aggressive and multifaceted trust offensive. This isn't just random pushback, it seems like a calculated campaign. They filed a lawsuit against one prominent short seller. They achieved full Sarbanes-Oxley, or SOX, compliance that remediates prior financial control weaknesses. They executed that share buyback program we mentioned, and they're highlighting that insider ownership is approaching 20%. This is a deliberate effort, it seems, to build credibility and signal management's own conviction right in the face of these very damaging allegations. It's a very public fight for their legitimacy.
And supporting this trust offensive, as you call it, is their corporate governance and leadership team. Their team boasts executives with backgrounds at Microsoft, Intel, HPE, and their board includes some high-profile individuals with deep government and international affairs experience, like Dr. Evan Medeiros, who served on the U.S. National Security Council, and the Right Honorable Ruth Kelly, a former UK cabinet minister. What does that caliber of leadership bring to the table for a company like Gorilla?
Well, the presence of directors with those kinds of pedigrees and high-level government networks, it provides Gorilla with invaluable credibility and potentially access when they're bidding for these sensitive national infrastructure projects.
Right, the connections.
Exactly. This geopolitical expertise is a difficult-to-replicate competitive advantage. It directly supports their unique business model. And it serves as another layer in their whole credibility by association strategy we talked about. When you're dealing with billion-dollar government contracts in sensitive regions around the world, having people on your board who understand that world, who have navigated it, that's indispensable. It adds a significant layer of perceived legitimacy to their claims of operating at that national, even international scale.
Okay, and finally, it's worth just touching on how Gorilla navigates market perception more broadly. They seem extremely popular on social media platforms. They exhibit some of those Memestock characteristics, and they're actively promoted by investor relations firms. What's the impact of that on the stock?
Yeah, that strategy of energizing their retail investor base can actually be a modern form of corporate defense. It can create a powerful counterweight to that short seller pressure. However, it also definitely contributes to the stock's high volatility, and it can deter more conservative institutional investors who often shy away from stocks perceived as meme-like, especially when you add in negative mentions from prominent market commentators. So it's really a double-edged sword. It can rally passionate support, but it might also limit their appeal to a broader, potentially more stable, long-term investor base.
Okay, looking forward then. The cornerstone of GRRR's future growth story seems to be this massive sales pipeline. Management claims it exceeds $5 billion in qualified leads. That's a staggering number.
It is a staggering number. And while it sounds incredibly impressive, the key for you, the potential investor, is to monitor the conversion rate. How much of that pipeline actually turns into firm, signed, revenue-generating contracts? That $1.8 billion Thailand OU, for example, it remains non-binding. Its conversion into a definitive contract is a critical, almost binary event. It could dramatically alter GRRR's growth trajectory for the next decade or more. If it converts, it's a huge win, validates the model further. If it doesn't convert, well, it leaves a significant hole in their future projections and maybe raises questions about converting other large pipeline deals.
So we've talked a lot about the high-growth strategy of these massive deals, but it seems intrinsically linked with a commensurate level of high risk across multiple domains, doesn't it? What are the biggest risks you see here?
Exactly. That's the crux of it. High potential reward, but very high risk. And these risks are highly interconnected. They feed off each other. First, there's that extreme customer and geographic concentration we discussed, particularly with the $270 million Egyptian contract. This leads directly to significant currency risk because of the volatile Egyptian pound. Remember that $7.2 million foreign currency loss in Q1 2025 alone. That's a direct hit to the bottom line.
Yeah, huge impact.
Then there's monumental execution risk. Delivering these huge, complex national projects on time, on budget, it's incredibly difficult. Delays or cost overruns could be disastrous. We also have the ongoing credibility and legal risks stemming from those short seller fraud allegations and the related investor lawsuits. That cloud hasn't gone away. And the company faces financing and dilution risk. New large projects might require additional, potentially costly financing. And those outstanding warrants, they continue to dilute existing shareholders as they're exercised. Finally, there's significant geopolitical risk. Operating in politically sensitive regions means contracts can be jeopardized overnight by changes in government, policy shifts, or regional instability. And consider how these risks intertwine. Imagine, say, a political issue in Egypt causes a project delay. Okay, that's bad enough. But that delay could also worsen the financial impact if the Egyptian pound devalues further during the delay.
Right, a double whammy.
Exactly. And that negative financial result, it would provide fresh ammunition to the short sellers, likely depressing the stock price further, which in turn makes it more difficult and more dilutive for GRRR to raise capital for future projects. So while management is clearly working to mitigate these risks through diversification efforts, strategic partnerships, it is objectively a very fragile system right now. One major shock could have cascading effects.
So, wrapping this all up, what does this mean for you, our listener? GRRR Technology Group, Inc., GRRR, it's clearly not a conventional investment, not your standard tech stock. It's a high-octane, high-risk, special situation security. That seems fair to say. The company is attempting a really difficult maneuver, trying to scale into a global AI infrastructure provider through just a handful of massive international contracts, all while fighting this very public war over its own legitimacy.
That sums it up well. The potential reward here is substantial, no doubt about it. If management successfully converts that pipeline, if they execute these massive projects profitably, and if they navigate these immense risks effectively. A lot of ifs. However, the risks are equally substantial and simply cannot be understated. This is fundamentally a speculative bet on management's ability to navigate a minefield. It's likely only suitable for sophisticated investors with a very high tolerance for risk, a long-term investment horizon, and frankly, the capacity to withstand extreme volatility, because volatility seems almost guaranteed here. And it's crucial, absolutely crucial, to view this company not as some kind of undervalued SaaS play. The margins just don't support that narrative right now. View it as what the numbers suggest it is, a high-risk project-based systems integrator operating primarily in emerging markets.
Right. And for those of you who choose to monitor this fascinating, if complex company, here are the key performance indicators, the things to really watch. Keep a very close eye on their pipeline conversion rate, especially whether that huge $1.8 billion Thailand MOU actually converts into a definitive binding contract. That's probably the biggest single catalyst or risk factor out there. Track their customer diversification efforts. Is revenue becoming less concentrated over time? Are they landing significant deals outside Egypt and Taiwan? Watch the gross margin trend. Can they improve it from that 35% level? Any uptick there would be significant. Pay close attention to their GAAP profitability and, critically, their cash flow from operations, not just adjusted figures. And keep an eye on those unbilled receivables on their balance sheet. Are they converting that recognized revenue into actual cash efficiently? And of course, you have to monitor the status of any legal proceedings, both the lawsuit they filed and any lawsuits filed against them. So what stands out to you about GRRR Technology Group? Is it potentially a phoenix rising from the ashes of controversy, poised for massive growth? Or is it maybe a house of cards built on grand promises, but ultimately reliant on low-margin, high-risk projects? Lots to think about there. We'd love for you to keep exploring these fascinating, complex topics. Thank you for joining us for this deep dive. We hope this gave you a clearer, perhaps more informed picture of GRRR Technology. Until next time.